The dual-layer principle in finance. The rich are not always the ones with the most assets, but they are the ones who know how to layer their assets intelligently and sustainably. While many people try to make money quickly and look for risky investment opportunities, the rich build their assets strategically and sustainably. The dual-layer principle is how they divide their assets into different layers. Each layer has a different level of risk, thereby protecting and developing their assets firmly. The rich never put everything on one gamble. They always have a financial system with a safety cushion, helping them never fall into a dangerous financial situation when encountering unexpected fluctuations. This principle is like building a house with many floors. Each floor has its own task and complements each other, thereby creating a stable financial system. Why the rich don't take risks without thinking. One of the common misconceptions is that the rich are always reckless, daring to invest in big, risky opportunities without fear. But the truth is different. The rich don't take risks without thinking, but they know how to take strategic risks, always calculate carefully, and prepare enough financial protection buffers before participating in risky decisions. They don't invest in areas that they don't understand or don't have enough data to analyze the risks. On the contrary, they understand the principles of financial safety, know when to invest, when to withdraw, and most importantly, know how to build a survival layer and a safety layer before thinking about high-return investment opportunities. A typical story to illustrate this is that of John, a British real estate investor. When he started his investing career, John had some great successes in this field, but then he lost everything when he invested in a project without properly assessing the risks. John's story. John, 42, a famous real estate investor in London, had made millions of pounds from successful real estate deals. With the experience and confidence gained from years of hard work, John began to expand his investment portfolio into new areas, such as coins, derivatives, and technology startups. In a short time, he saw outstanding profits from these investments. However, this success made John overconfident and thought that he could do anything without risk. He decided to put all his money into risky investments without preparing his asset structure in advance. As a result, when the cryptocurrency market crashed in 2022, John not only lost all his money, but also fell into debt. Analysis of the reasons for failure. The reason John failed was because he did not understand that assets must be built on a solid foundation. While risky investments can bring high returns, they also come with great risks. John did not have enough asset cushions to protect himself from these fluctuations. He lacked a survival layer, cash for emergencies, and a safety layer, highly stable, low-risk assets. If John had built safe asset layers before embarking on risky investments, he could have protected his assets from major shocks. Having a stable income stream from low-risk investments like rental properties or dividend stocks will help John have a steady income stream and not have to rely solely on speculative investments. The difference between the rich and the beginners. A big difference between the rich and the beginners is how they view risk. The rich understand that investing is not about taking a gamble without preparation, but about building a solid financial structure before participating in high-return opportunities. This requires them to divide their assets into different layers to ensure that even if one investment fails, they still have enough assets to stand on. Beginners often tend to go all in on a single opportunity because they want to get rich quick. They often do not have enough cushion to protect them, and when the market changes, they can easily get caught up and lose everything. This shows that the rich are not luckier, but those who know how to prepare carefully and build assets sustainably. Therefore, the rich do not take reckless risks, but they take risks within a pre-calculated area, with a solid financial foundation. The dual-layer principle is a strategy that helps them build assets from the bottom up, protect, and develop assets sustainably. Start from the survival level. Build a safe and stable profitable foundation before participating in risky investment opportunities. Once you understand this principle, you will no longer be afraid of market fluctuations and can confidently step into larger investment opportunities. 2. The rich are daring but have a safety cushion. Analysis of the rich who don't make risky financial decisions without a cushion of assets. In the financial world, it is often thought that the rich can take risks and put everything on big bets. However, the reality is completely different. The rich are not reckless people without calculation, but they understand that risks always exist, and they have a solid asset cushion to protect themselves from unforeseen financial fluctuations. The rich know that even though they can participate in risky investments, they always protect their underlying assets. Large investments in real estate, stocks, or technology startups can bring huge profits, but without a solid financial system at the bottom, everything can collapse due to an unexpected shock. Mark's story: a successful real estate investor who lost everything without a solid financial system. Mark, 45, is a well-known real estate investor in London. After working for many years in the financial industry, he accumulated a large amount of capital and started investing in real estate. Mark has been successful with a number of large projects, earning millions of pounds from buying and selling land and renting houses. Thanks to smart decisions, he quickly became one of the prominent investors in this field. However, everything began to change when Mark decided to expand his portfolio and started investing in risky markets, such as cryptocurrencies, derivatives, and technology startups. Although he initially made large profits from these projects, Mark did not realize that he had overlooked an extremely important factor: building a solid financial system. At the bottom, Mark's failure: no asset cushion. When the cryptocurrency market crashed in 2022 and global stocks crashed, Mark had no assets left to cover his losses. Most of his risky investments were wiped out, while he had no solid asset cushion to protect himself. As a result, in just a few months, Mark lost most of the assets he had earned over the years. The survival layer, the ultimate safety cushion. The survival layer is the first and most important asset cushion that every individual needs to have in their financial journey. It is an emergency fund that protects you from unforeseen financial shocks. No one can avoid risk, but those who understand the principles of financial security know that having an emergency fund and safe assets is extremely important. The survival layer is not about getting rich, but about protecting your finances from volatility and not having to face losing everything when something goes wrong. These are highly liquid, low-risk assets such as cash, flexible savings accounts, health insurance, accident insurance, or stable real estate such as a rental property. The survival layer helps you maintain financial stability during difficult times, such as when you lose your job, have a health problem, or experience an economic crisis. The survival layer is like an oxygen tank that helps you survive through hardships without having to worry about borrowing or selling off assets. Safety layer: protecting asset value. After you have your survival layer, the next step is to build a safety layer to protect the value of your assets from depreciation due to inflation and financial fluctuations. This layer does not necessarily have to generate high returns, but it does need to help protect your assets in a stable and sustainable way. Safety layer assets include gold, rental real estate, government bonds, and long-term fixed-interest savings accounts. These assets are low risk and are not affected by short-term market fluctuations. When you have a solid safety net, you don't have to worry about short-term fluctuations in your asset value. Lessons from Mark's story. Mark's story is a clear lesson about the lack of a solid financial system. If Mark had a solid survival and safety net, he would have been able to withstand financial shocks and not be swept away by market fluctuations. This financial protection has helped many people avoid losing everything when participating in risky investments. Conclusion: build a safety cushion before investing. Survival and safety nets are not far-fetched concepts or only for the wealthy. They are important foundations that anyone can build from the first steps in their financial journey. Start with a survival net. Accumulate enough money to ensure you can overcome unforeseen difficulties. Then, build a safety net to protect your assets from financial shocks. Once you have a solid foundation, you can engage in risky investments in a controlled and intelligent way, minimizing risk and maximizing profits. The rich do not take reckless risks, but rather take strategic risks. They understand that investment decisions are not about betting everything on a single bet, but about building a solid financial foundation before taking risks. Learn from them and build a sustainable financial strategy to protect and grow your assets intelligently. 3. Asset layers according to the dual layer principle. Survival layer, the first and most important layer. In the dual layer principle, the survival layer is the most basic and important asset layer, acting as a financial protection layer for each individual. It is not where you make money, but it is where you maintain financial stability in difficult times, especially when unexpected events occur. The survival layer is not an option, but a prerequisite if you want to survive in the financial game. Without the survival layer, you may collapse when faced with financial shocks, whether it's illness, job loss, or other emergencies. Once you lose the survival layer, you will not have enough finance to continue investing, and recovery will become extremely difficult. The importance of the survival layer. The survival layer does not make you rich, but protects you from financial loss when unexpected events occur. This is a foundation layer, without which you cannot build any solid asset layer above. That is why wealthy people always know how to build a survival layer before starting to venture into other types of investments. The survival layer, not to get rich, but to protect you. The survival layer can include assets that are easily converted into cash and have a very low risk level. For example, these are short-term savings, emergency funds in the bank, health insurance, accident insurance, and flexible savings accounts that can be withdrawn at any time without penalty. The survival layer is a lifebuoy in a volatile financial market. Imagine, if you are on a boat in the middle of the ocean, the survival layer is a life buoy that helps you maintain life when the boat encounters a storm. If you do not have a life buoy, you will easily be sucked into the water when encountering a big wave. John's story, the man who built a solid survival floor. John, 38, is a man living in London. After working for many years in the banking industry, he had accumulated a small amount of savings and started looking for investment opportunities. However, John was not in a hurry to jump into risky investments. Instead, he decided to build a survival floor first. John used part of his savings to create a contingency fund in his bank account, enough to cover living expenses for 3 to 6 months in case something happened. He also bought some health and accident insurance to protect himself from unforeseen incidents. He even had a short-term savings deposit to keep cash ready when needed. When the COVID-19 incident happened, the labor market in London was drastically disrupted. Many of John's colleagues lost their jobs and had to borrow money to get by. However, John was not affected too much because he had a solid survival layer. He did not need to borrow money or sell off assets because he was prepared. While everyone else was worried about their financial situation, John just needed to use his savings to maintain his life and look for safe investment opportunities. With a solid survival layer, John could calmly overcome the crisis and be ready to invest in better opportunities when the market recovered. Survival layer helps you survive through events. The survival layer is not a place for you to accumulate large assets or make quick profits. It is simply a financial buffer that helps you not to go bankrupt when encountering unexpected situations. For people without a survival layer, just a small event like losing a job or getting sick can wipe out all the assets they have accumulated. To better visualize this, you can imagine the survival layer as a defensive wall that helps you protect your assets from unexpected risks. Once you have no defensive wall, you'll be easily defeated in the financial war. Assets in the survival layer. The survival layer usually includes assets that are easily converted into cash and have a low risk level, such as the following. Cash, a deposit in a savings account that can be easily withdrawn when needed. Emergency fund, an amount of money that has been reserved for emergencies, such as illness or job loss. Health insurance, ensures that you will not be in financial difficulty when you need health care. Flexible savings accounts, accounts that can be easily withdrawn in an emergency without penalty. Accident insurance, to protect yourself and your family from unforeseen accidents. Conclusion, the survival layer is not the layer that will make you rich, but it is the first and most important layer in the process of building a solid asset. Without this layer, you will be very vulnerable to collapse when faced with emergencies or unexpected financial events. Start with a survival layer, making sure you have enough assets to sustain your life in difficult situations before starting to participate in high-risk investments. The survival layer not only protects you from financial risks, but also helps you stay calm and control your financial decisions more intelligently in the future. Starting from here, you will build a solid financial foundation and be ready to step up to the next asset layers safely and effectively. Safety layer, protecting your assets from loss over time. In the dual layer principle, the safety layer is the second and most important asset layer in a person's financial strategy. Once you have built your survival layer, where you have an emergency fund and assets that can be easily converted into cash. The next step is to build your safety layer. This is where you protect the value of your assets that have been accumulated from the decline due to inflation and the volatility of the financial markets. The safety layer will not make you rich quickly, but will help you maintain your assets against the volatility of the financial world, helping you to be more stable on the path to wealth. Not everyone can become a millionaire quickly, but if you have a solid safety layer, you will easily maintain and protect your assets in the long term. The importance of safety layer. The safety layer is the asset layer that helps you maintain the value of your assets against economic shocks and the impact of inflation. These are assets that are highly stable and less subject to strong market fluctuations. While many people are easily drawn to short-term investments with attractive returns, the safety layer helps you maintain long-term financial stability, protecting you from unforeseen uncertainties. The safety layer does not necessarily have to be highly profitable, but it must be stable and protect your assets from depreciation and loss. In fact, assets in the safety layer such as gold, bonds, stable real estate, or life insurance are solid financial protection layers, helping you not collapse when the market is difficult. The safety layer is not to get rich, but to maintain value. People often mistakenly think that the safety layer is where they make money, but the truth is not. This is where you keep highly stable and low-risk assets, to ensure that you will not lose what you have accumulated. The safety net protects you from asset depreciation, allowing you to continue building other asset classes without worrying too much about risk. A good example is gold. Although it does not yield as much as some other investments, gold is an asset that has held steady in value for decades. This is why gold is often considered a safe haven during economic turmoil. Similarly, government bonds are also a safety net asset, providing a stable yield and less affected by stock market volatility. Mark's story. The importance of a safety net. Mark, 42, is a tech worker in London. Over the years, he has accumulated a large amount of money from his job and successful investments. However, instead of risking it all on short-term, high-risk investments, Mark decided to build a solid safety net for his assets. Mark invests in gold and government bonds. He also buys life insurance to ensure his family's financial protection in the worst-case scenario. Although these investments do not yield as high returns as stocks or real estate, they have helped to maintain his assets without being affected by short-term market fluctuations. When COVID-19 broke out and the global economy was severely affected, many people in the tech industry, like Mark, lost their jobs or faced pay cuts. However, Mark was not as badly affected as many of his colleagues because he had a solid safety net. He did not need to sell assets or borrow money to cover his living expenses because he had a stable financial reserve fund. Even when the price of gold skyrocketed during the pandemic, he made a significant profit from holding gold. Mark understands that the safety net is an indispensable part of his financial strategy. He not only builds assets through high-yield investments, but also protects his assets from negative external impacts. Safety net assets. The safety net usually includes assets that are highly stable, low risk, and have the ability to protect you from the loss of assets. Here are some common assets in the safety net. Gold. This is an asset with a stable value and is easy to trade. Gold has been considered a safe haven for thousands of years. Government bonds. These are debt securities issued by the government. Government bonds are highly stable and are less affected by fluctuations in the financial market. Life insurance ensures financial protection for the family and helps maintain income in case of loss of ability to work. Stable real estate. Real estate assets have real value, such as houses, land, and are less affected by strong market fluctuations. Conclusion: the safety layer is not a place for you to make money, but it is an extremely important layer in a long-term financial strategy. It protects you from financial risks and fluctuations, helping you maintain assets throughout your life. When you have a solid safety layer, you will not need to worry when facing unexpected events, and can continue to build other layers of assets without fear of collapse. Start building your safety net today, so you can calmly overcome any financial challenges in the future. Your safety net is the first step to help you go from survival to sustainable success in this volatile financial world. Stable income layer, creating stable cash flow from predictable, low-risk assets. In the dual-layer principle, The stable income layer is one of the important layers that helps build a solid financial foundation. This is an asset layer that focuses on creating stable cash flow from predictable, low-risk investments. The goal of this layer is not to seek huge profits, but to ensure that your assets can generate passive income, giving you financial freedom without having to work too hard. The stable income layer is the stage of transitioning from having to work continuously to earn money to having your money work for you. This layer usually includes low-risk investments that bring in a steady income, allowing you to maintain your life without having to depend entirely on your main job. What is the stable income layer? The stable income layer is where you focus on assets that can generate passive income without much intervention. These assets are less affected by strong market fluctuations and provide stable cash flow over a long period of time. Popular assets in this layer include rental properties. This is one of the most popular ways to generate stable cash flow. If you invest in real estate with stable value and rent it out for a long time, you will receive a regular monthly income from the rent. Dividend stocks. Investing in stocks of large, stable companies that pay regular dividends is a way to generate passive cash flow. Dividends are the portion of profits that the company distributes to shareholders, allowing you to receive regular money without having to sell the stock. Long-term investment funds. Long-term investment funds with methodical capital allocation strategy are another option to generate stable cash flow. These funds typically invest in companies that have the potential for steady growth and sustainable returns. Small business models with stable cash flows. Sometimes, it is not necessary to invest in large assets to generate stable cash flows. A small, stable business model such as a grocery store, repair service, or a business that provides essential products can also generate stable cash flows each month. Illustration, Jack's story. Jack, 45, has spent his entire life building a solid career in finance. However, instead of focusing solely on earning money from his main job, Jack decided to create a passive income stream to secure his family and future. One of Jack's most important decisions was investing in rental properties. After years of hard work and saving, he bought a number of small apartments in London. These apartments were rented out long-term and provided Jack with a stable monthly income. Thanks to this income, Jack not only maintained a comfortable life, but also had enough money to invest in other opportunities without having to worry about finances. In addition to real estate, Jack also invested in dividend stocks of large and reputable companies, such as Unilever, BT Group, and HSBC. These companies have a long history of paying dividends to shareholders, allowing Jack to generate steady cash flow from his investments without having to sell shares. One of the key lessons Jack learned was not to invest in assets that can appreciate quickly, but to focus on assets that generate steady cash flow, helping protect and grow your assets in a sustainable way. The importance of a stable income layer. A stable income layer is not a place to make money quickly, but it is a solid foundation for achieving financial freedom. Having a steady stream of passive income will help you reduce financial stress and create long-term stability in your life, allowing you to focus on long-term goals without worrying about making money every day. How to build a stable income layer. To build a stable income layer, you need to take some basic steps. Build a solid financial foundation. Before you can create a stable cash flow, you need a survival layer and a safety layer to protect your assets from unexpected risks. Invest in passive income assets. Look for investment opportunities in real estate, dividend stocks, or stable business models. These assets will help you create a steady cash flow without having to worry about market fluctuations. Maintain financial stability. Once you have a stable cash flow from your investments, continue to monitor and manage your finances carefully. Don't let greed or market fluctuations make you lose control. Conclusion: a stable income layer is an important part of your long-term financial strategy. This is where you create a steady stream of passive income from assets that are easy to control and low risk. This layer will not get you rich quickly, but will help you maintain and protect your assets throughout your life, while helping you reduce your dependence on work and move towards true financial freedom. Like Jack's story, building a steady cash flow is a smart move that will keep you steady in the changing market landscape and not worry about losing your assets when financial storms come. Start building a steady income layer today, and you will see results long-term. Growth layer, high growth potential, but also comes with greater risk. In personal finance, the growth layer is one of the most important asset classes. This is where you start investing in opportunities with high growth potential, but also accept greater risk. The goal of this layer is not to preserve assets, but to grow assets with the expectation of achieving superior returns. However, like any high-risk investment, investing in the growth layer requires you to understand what you're investing in, as well as being able to manage the risk. What is the growth layer? The growth layer includes investments with high growth potential, but also comes with greater risk. These investments can include investing in new businesses. Startups can be very profitable when successful, but the failure rate is very high. Investing in these businesses requires you to have an understanding of the market, business model, and growth potential of the company. Growth funds. These investment funds mainly focus on companies that are growing strongly and have high potential. However, these funds can be volatile and are not suitable for those with low risk appetite. High-yield real estate. Investing in real estate can bring great profits, especially when you invest in rapidly developing areas or projects with strong growth potential. However, the real estate market can be highly volatile and have high liquidity risk. Technology startups. Investing in technology companies, especially new startups, can bring huge profits if the company is successful. However, these companies often have a very high failure rate and require you to have a good understanding of the technology and potential of the products. Illustrative example, Tom's story. Tom, a 35-year-old man living in London, is a good example of how to invest in the growth layer. After building a stable financial foundation with investments in rental properties and dividend stocks, Tom started investing in technology startups and growth funds. Tom was not an early investor in technology companies, but after gaining a solid financial foundation, he decided to try his hand at new opportunities. He started investing in a technology startup that specialized in developing artificial intelligence, AI, software. Although Tom was not a technology expert, he spent time researching and understanding the company as well as the potential of this industry. As a result, after 3 years, the company that Tom invested in attracted the attention of major venture capitalists and led to a large funding round, helping the company grow strongly. Tom has made a return of 5 times his initial investment, but he also understands that investing in this company is not without risk. He has accepted the risk and is willing to lose everything if the company fails. In addition, Tom has also invested in a growth fund, where his money is allocated to companies with high growth potential. Although this fund has high volatility and cannot guarantee profits, Tom has correctly assessed the potential of the companies in the fund and is mentally prepared to accept the risk. The growth tier is not all roses. An important thing that Tom realized is that the growth tier is not a quick path to wealth. Investing in these opportunities requires knowledge, experience, and a mental preparation to accept risks. While investing in large, stable businesses or real estate can provide solid protection for your assets, the growth stage offers great opportunities, but also challenges. Tom never puts all his money into a single opportunity. He always maintains a diversified investment strategy, allocating his assets to different sectors to minimize risk. He understands that risk is an integral part of growth stage investing, and he is prepared to lose money in some investments. The importance of knowing risk limits. While growth stages can bring great returns, knowing your risk limits is extremely important. Tom always has a backup plan and never invests money that he cannot afford to lose. He understands that risk control is essential in growth stage investing and never lets greed rule his investment decisions. One of the key lessons Tom learned was that investing in high-potential startups or real estate is inherently risky, and he must always be prepared for unexpected shocks. Conclusion: investing in the growth layer, a controlled growth strategy. The growth layer is where you put your capital first and expect higher than average growth, but not everyone should enter this layer without proper preparation. Knowledge, diversification, and risk control are the key factors that help you succeed in the growth layer without getting caught up in the market trap. As Tom's story shows, understanding the risks and having a clear strategy when investing in the growth layer will help you grow your assets sustainably without worrying about losing everything. The development floor is not an easy road, but with the right preparation, you can achieve outstanding returns from these promising investment opportunities. Speculative tier. The final tier High-risk opportunities. In personal finance strategy, the speculative tier is an important but also risky part, reserved for investments that have very high growth potential, but also carry a high risk of loss. This tier mainly includes types of investments, such as cryptocurrencies, speculative stocks, real estate flipping, and short-term investment opportunities. Although the rate of return can be very attractive, this is also where investors can easily lose everything if not managed properly. What is the speculative tier? The speculative tier includes assets that have a very high level of risk, but also have extremely high profit potential. These investments are not only highly volatile, but also difficult to predict, often associated with rumors, prominent trends, or hot markets. Due to their unpredictable nature, speculative investments require investors to have a high tolerance for risk and not rely on a long-term investment strategy. These investments can be cryptocurrency. Bitcoin, Ethereum, and other coins have emerged as a global phenomenon in recent years. Although they can generate large profits, they are also extremely volatile and are greatly influenced by news and external factors. Speculatory stocks. Stocks of emerging companies or companies with breakthrough growth potential can generate large profits. However, they can decrease in value very quickly when they are no longer suitable for the market or have difficulties in business operations. Real estate flipping. This is a form of real estate investment with the goal of buying and selling quickly to make a profit. These investments can be very profitable in the short term, but also have many potential risks when the value of real estate does not increase as expected. Short-term investment opportunities. Short-term investment opportunities, such as day trading stocks, technology investment projects, or other investment contracts, are often volatile and volatile. Illustrative example, James' story. James, a 35-year-old investor from Manchester, is a typical example of speculative investing. James started his investing career in real estate after accumulating a certain amount of money from his first job. But after witnessing the growth opportunities in cryptocurrency and speculative stocks, James decided to try his hand in these markets. Initially, James had little knowledge about cryptocurrency, but he was fascinated by the stories of people becoming rich thanks to Bitcoin and other cryptocurrencies. He decided to buy Bitcoin and Ethereum with an amount of money that he felt he could lose without affecting his personal finances. In the first months, he saw the value of the coins increase sharply, bringing him great profits. However, when the cryptocurrency market became volatile in 2022, the value of Bitcoin and Ethereum dropped rapidly. James lost a large portion of his initial investment, but thanks to his solid financial preparation from the previous layers, he did not suffer too much loss. He spent a small portion of his assets on speculation while maintaining a solid survival layer and safety layer. In addition to cryptocurrency, James also started to try investing in speculative stocks of an emerging technology company with strong growth potential. The profits from this stock were extremely attractive when the company released a breakthrough product, but then the company faced a lawsuit and the company's stock plummeted. Once again, James lost a portion of his capital, but thanks to his solid financial structure, he did not fall into financial ruin. Speculative layer is not the only way. One of the things James learned was that the speculative layer is not the only way to get rich, but it is only part of an overall investment strategy. He does not put all his money into speculative investments, but always has a clear risk management plan. Investing in the speculative layer can bring quick profits, but also comes with uncertainty and volatility. James understood that the speculative layer can bring huge profits, but it is only a small part of an overall investment strategy. Managing risk and not letting your assets be too affected by market fluctuations is essential to maintaining a strong financial position. The importance of knowing your speculative limits. Risk management is key in the speculative layer. James always remembers that investing in speculative investments is not everything, and he only puts a small part of his assets into it, never investing all in. He understands that speculation is a supplement, not the focus of his financial strategy. An important principle in the speculative layer is not to let greed dominate. These investments can easily make you believe that you can become rich in a short time, but you need to understand the risks and control your emotions when the market changes. Keeping a cool head and not getting caught up in the fever is the key to investing with control. Conclusion: speculation is important, but needs a solid cushion. The speculative layer is an important part of a personal finance strategy, but it is not everything. These investments have great potential, but come with a lot of risk. Successful investors are not those who always go all in on a gamble, but those who understand the risks, have a clear investment strategy, and know when to get out. As James' story shows, speculation can be part of an investment strategy, but you need a solid financial foundation from the survival layer, the safety layer, and the stable income layer to be able to withstand financial shocks and continue to grow your assets sustainably. The speculative layer can bring quick profits, but only if you know how to manage risk and not let it dominate your entire assets. Always make sure you have a solid cushion before entering the world of risky investments. 4. How to build wealth using the dual layer principle. Building wealth is not just about making money and investing in attractive opportunities. To have a solid and sustainable financial system, you need to build your assets from the bottom up, starting from the survival level and gradually moving up to higher levels such as the safety level, the stable income level, the growth level, and finally the speculation level. Building each level of assets will help you have a comprehensive financial strategy, protect you from unforeseen fluctuations, and help you grow your assets sustainably. Rachel's story, a woman who built a solid foundation. To illustrate this principle, let's look at the story of Rachel, a simple woman from Manchester. Rachel is an office worker and lives a fairly modest life. She is not a high-income earner, but she has understood one important thing. A solid survival layer is a foundation that will help her avoid financial risks throughout her life. Survival layer. Where to start? From the beginning of her career, Rachel has always focused on building her survival layer. She saves a certain amount of money every month and starts investing in safe, liquid assets such as bank deposits, flexible savings accounts, and life insurance. Although her income is not high, she always makes sure that she has a large enough reserve fund to use in emergencies such as job loss, illness, or any other financial shock. Every month, Rachel regularly takes a portion of her income and deposits it into a long-term savings account. She also buys a few taels of gold every year, not to invest for immediate profit, but to protect her assets from depreciation due to inflation. Rachel understands that her survival layer is not about getting rich quick, but about protecting herself from unexpected shocks in life. The importance of the survival layer. Rachel has always viewed her survival layer as a safety net in her financial life. She does not let her money evaporate into risky investments without solid preparation. This has proven to her an important point. A solid financial foundation is a decisive factor that helps you not lose everything when investment opportunities unfortunately fail. Rachel's story is a living example of the principle of building assets from the bottom up. She understands that without a solid foundation, any investment in real estate, cryptocurrency, or speculative stocks can cause her to lose everything. The survival layer is the cushion that protects her from unforeseen risks and helps her maintain financial stability in difficult times. Don't skip the safety floor. Once she had built up a large enough emergency fund, Rachel began to focus on building a safety floor. She did not rush into risky investments, but instead decided to invest in gold, bonds, life insurance, and stable real estate as a way to protect her assets from depreciation over time. These investments did not require complex knowledge or take on much risk, but they helped Rachel preserve the value of her assets over the long term. This was a smart financial strategy that kept her from being caught up in market fluctuations while still ensuring her assets were protected. Learn from Rachel. Build wealth slowly and sustainably. Rachel is not a big investor. She does not chase hot trends or promises of a get-rich-quick opportunity. She understands that the most important first layer of wealth building is the survival layer. Having a solid survival layer ensures that you always have a backup asset when needed, and also allows you to avoid being caught up in thoughtless financial decisions just because of the appeal of short-term profits. Rachel's story shows that financial success does not come from making money quickly, but from building a smart, sustainable financial strategy and being patient in accumulating assets. Her saving money and investing in safe assets is a testament to the dual-layer principle of wealth building. Rachel does not need a high income or a super-rich job to build a solid financial foundation. She just needs to persevere, build the survival layer first, and always understand that her assets need to be protected by maintaining financial stability in any situation. Conclusion: Rachel's story shows that the survival layer is the most important part of the personal financial system. It not only helps you maintain financial stability in emergency situations, but also gives you the ability to step up to higher levels in the asset-building strategy. Financially intelligent people not only know how to make money, but they also know how to protect their assets. The financial structure must be built from the bottom to the top, starting with safe layers like the survival layer, then moving on to the development and speculation layers. Rachel, through her story, has taught us an important lesson about patience and building sustainable assets from solid foundations. Why rich people succeed. In the financial world, rich people are not those who seek opportunities to get rich quickly or make reckless investments. On the contrary, they are those who build solid assets, are patient, and have a clear long-term strategy. Through smart financial decisions and the ability to control risks, they create a stable financial foundation for sustainable development, even when facing strong fluctuations from the market. Robert's story, smart investors and building a solid asset layer. Robert, a 45-year-old man living in London, is a typical example of a smart investor. Robert started his career with a simple office job and a not-so-high salary, but he always had a long-term vision. Although he started from nothing, Robert gradually built his assets through a process of perseverance, from small investments to big financial decisions. Survival tier. Start with a solid foundation. Robert understood that the survival tier was the first important element in building wealth. He spent the majority of his income accumulating an emergency fund for his family and himself. Each month, he set aside a portion of his income to deposit into a flexible savings account, while also ensuring that he had a certain amount of cash to cover emergencies, such as job loss or illness. In the early years, Robert did not seek risky investment opportunities. Instead, he focused on protecting his assets from unexpected financial shocks. Although not profitable quickly, his savings and investments in safe financial products helped him overcome difficulties during the early stages of his career. Safety tier, protecting asset value. Once Robert's finances began to stabilize, he decided to move on to building a safety tier. Robert did not rush into investments that would generate quick returns, but instead, he continued to maintain stable, low-risk assets. He began investing in gold, government bonds, and life insurance. These investments not only protected the value of Robert's assets, but also helped him maintain financial stability, even when the market experienced major fluctuations. It is important that Robert understood that the safety layer was not about getting rich, but about protecting what he already had. He knew that in a volatile world, maintaining his assets was an important factor in being able to move forward in the future. Stable income layer, creating passive cash flow. Once Robert had built enough solid asset layers, he continued to build a stable income layer. He decided to invest in rental properties, dividend stocks, and long-term funds. These investments help Robert generate a steady stream of passive income without having to work too much. With these assets, Robert does not need to worry about not having enough money to cover his daily living expenses because he has a steady stream of income from his profitable investments. While many people rush to seek risky investment opportunities, Robert understands that stability is an important factor in building sustainable wealth. The steady cash flow from these investments gives him enough financial freedom to continue investing in new opportunities without having to worry about losing everything if one of the investments fails. James' story, a small business in London. James is a small business owner in London who owns a small retail store. He is not a professional investor, but James understands the principles of building sustainable assets. Over the years, he has continuously invested in safe assets and gradually built a solid financial foundation. James always maintains a survival layer and a safety layer for himself and his family. Every year, he takes a portion of the profits from the store to invest in gold and government bonds. These investments do not bring quick profits, but they protect him from risks due to unpredictable fluctuations in the market. When the revenue from the store is stable, James continues to invest in rental properties, which can generate a steady passive income stream. In this way, he does not have to depend entirely on the income from the store, but has another source of income to support his life. Growth tier and speculative tier, risk consideration and control. Once they had solidly established their core asset classes, Robert and James began to expand their investments into high-growth opportunities, such as startups and cryptocurrencies. However, they both knew that the growth tier and the speculative tier needed to be carefully managed. Both Robert and James devoted a small portion of their assets to speculative opportunities, but they did not let these opportunities consume their entire assets. They always defined their risk limits and did not invest too much in highly speculative investments. With this strategy, they were successful in maximizing their profits without being overly affected by the potential risks of these investments. Conclusion: the success of the rich comes from building solid assets. The story of Robert and James shows that financial success does not come from investing recklessly without a strategy, but from building assets from a solid foundation. By building a survival layer, a safety layer, and a stable income layer, they have created a solid financial system that protects and grows assets over the long term. The rich are not those who seek opportunities to get rich quickly, but those who understand the principles of building sustainable assets from the bottom to the top. They are patient, smart, and always have a clear financial strategy to maintain financial stability and sustainable development, even in the face of strong fluctuations from the market. 6. Conclusion: don't start at the top, build a solid foundation for your finances. In the personal financial journey, one of the important principles to achieve sustainability and success is the dual-layer principle. This is a financial strategy that helps you build assets in layers, from the survival layer to the speculative layer. Each layer will help protect you from unforeseen risks and at the same time create sustainable development opportunities. When you apply this principle correctly, you will understand that building assets is not a race to get rich quickly, but a patient and intelligent journey, creating a financial system that can withstand the fluctuations and challenges of the market. Understanding and applying the dual-layer financial strategy. The dual-layer principle is not simply about building valuable assets, but also about knowing how to manage risks and ensure financial stability. A person who understands and applies this strategy is not someone who only knows how to look for attractive investment opportunities, but someone who knows how to build a solid financial foundation from the bottom up. We cannot deny that some people can achieve financial success from quick and risky investment opportunities, but the truth is that very few people can maintain long-term wealth without a systematic financial strategy and a solid foundation. The story of Peter, a successful investor from London, is a typical example. Peter started his financial career with small investments, careful savings, and very slow but steady steps. Peter clearly understood that before participating in risky investment opportunities, such as cryptocurrencies or growth stocks, he needed to build a solid survival layer and safety layer. Survival layer, a solid foundation for personal finance. Peter started his financial career by building a survival layer. He didn't start with big investment opportunities, but focused on making sure he always had enough cash in his account to handle emergencies. Each month, Peter set aside a portion of his income to create an emergency fund and a flexible savings account. He even bought health and life insurance to ensure that he and his family would be financially protected in the event of an unexpected event like illness or job loss. Safety layer, protecting asset value. After building enough reserves and ensuring financial security for himself, Peter moved on to the safety layer. This is an important layer that not only protects the value of his assets from loss over time, but also helps him maintain financial stability. Peter decided to invest in gold, government bonds, and stable real estate. These investments not only help him protect his assets, but also ensure that they are not strongly affected by inflation or large fluctuations in short-term financial markets. Stable income layer. Passive cash flow generates stable income. Once he had built a solid financial foundation, Peter continued to invest in rental properties, dividend-paying stocks, and long-term mutual funds. These investments created a stable and passive cash flow for Peter. This cash flow helped him maintain his lifestyle without having to depend on work. The final question: what level are you on in your wealth building? One of the key questions Peter always asks himself is, what level am I on in my wealth building? And are the lower levels strong enough to support the risky decisions above? This is a question that each of us needs to ask ourselves when embarking on our financial journey. You may be on the growth level or the speculative level, but before you decide to move up to the higher levels, you need to build a solid foundation below. Without a strong enough survival and safety level, any risky investment decision can easily cost you everything. The final advice: don't start at the top. Finally, the advice for all of us is, don't start at the top. Start from a solid foundation, from the survival level, and gradually build the next levels. Building wealth is not a quick race, but a journey of patience, perseverance, and a clear strategy. Surely, if you know how to build each asset layer in a planned way, you will never have to fear financial fluctuations. You will always have the ability to deal with difficulties and challenges, and at the same time grow your assets in a sustainable and steady way. So, which floor are you on in your wealth building?